Hello there, this is Bruce at Fleet Capital Management. It is Friday afternoon, the 23rd of February, 2024. It has been a wild and strange week for the markets. We're going to take a look at it, everything that happened. This video is going to be a little different than most. We're going to spend just a very little amount of time on charts because I have a lot of other things that I would like to show you that happened this week. So I hope you find this interesting. Bear with me. As always, we need to say that the video presentation is intended for educational purposes only. The discussion of any security is not a recommendation to purchase or sell a security. You know I'm always available, Bruce at Fleet Capital Management. Homepage of our website, 2 buttons. The one on the bottom will take you to the most recent market analysis videos. The one on top will put you on my calendar so we can do a Zoom call together. So the first thing I want to talk about, and you'll see how all of this fits together in just a moment, but are stock prices manipulated? And when I say stock prices, I mean individual stocks and also the market. But today we're just going to look at a couple of individual stocks. Are they manipulated? I can't prove it, but it certainly seems obvious to me based on years and decades of observation. Let me give you an example. So NVIDIA, that was like the huge story this week that NVIDIA was going to announce earnings. And we'll come back to NVIDIA in a minute after I talk about manipulation. But NVIDIA was priced pretty high. I chopped this off right before their earnings. And for what seemed like no reason at all, the price came down pretty dramatically. And then right when they announced earnings, this is what it looked like. So NVIDIA is one of the best companies in the entire world. They're one of the most important companies when it comes to building equipment for AI. I saw absolutely no reason that they wouldn't post fabulous earnings, which they did, but that's not really the point. The point is, if you had a sense that NVIDIA was going to have great earnings, blowout earnings, and when I say you, I don't mean you and me. I mean multi-billion-dollar institutions, and they wanted to buy it cheaper. Is it possible that they pushed the price down in anticipation of these earnings and then to see a huge return in one day? I don't know. It looks kind of suspicious to me. If we go to SMCI, I'm doing this same day. This is pre-NVIDIA earnings. Granted, SMCI was above their linear regression, and I always tell you it should come back in, but this was enormous. I mean, in one day, it loses 20% of its value, and then it drops again, and it drops again right before NVIDIA announces earnings, and SMCI is part of that whole AI group of stocks that should benefit from AI. And then the very next day, we see this. So I do have a sense that the bigger institutions have the ability, and the people that work in the market have the ability to push prices down. And I'm going to go on about this in just a second. Actually, I'm going to do it right now. Let's say we talk about stop management all the time. And you see these dots. That's kind of ATR dots. In this case, these are called chandelier exits, but they're ATR dots basically. And many times I would put a stop right down here, okay, below that ATR stop. And if I had done that, we would have been stopped out of SMCI. We would not own SMCI. And the next day it went down, and you said, hey, you know what? Bruce is really smart. And the following day it went down further. Oh, wow. I'm so glad he got us out of that stock. And then after NVIDIA posts, it jumps 33%. You would have thought, man, we didn't get to take advantage of any of that because Bruce had us stopped out of it. So this, what I'm going to call manipulation, and again, I can't prove this, is one of the things that makes stop management so mind-numbingly difficult. So if you can see how we would have lost our position in SMCI, it would have gone down and then it would have spiked. So what my point is how do we handle stop management in this case? If this is true, if what I'm showing you is true, how do we handle stop management, and how do we handle earnings announcements? Well, two of the most difficult things in investment management. But when do these tend to happen? Here's another piece of evidence that I would suggest that stock manipulation is real, because they tend to happen when there are events like an interest rate announcement, a Fed speech, some breaking news that might even be non-investment related, has absolutely nothing to do with the investment world, but it's breaking news, it's big news, everybody's paying attention to it, stocks drop. Why did they drop? Why did they drop when it has nothing to do with investments? I believe it's because institutions have an opportunity to buy cheaper, and they shake. It's called shaking us out. They know where stops are generally located. They run the price down below that level. We lose our stock, and they buy that stock, and then the price runs up. And like I said, this is why stop management is so incredibly hard. It's because of these things. So I'll come back to how we handle earnings and stops in just a moment. But last week, here was the big thing that happened. Everyone said we should sell NVIDIA, but we didn't. Well, why didn't we? We didn't sell NVIDIA, and I mean Kathy Wood, who's a brilliant, brilliant manager, and she's from ARK. She owns ARK Investments, and CNBC and Wall Street Journal, and lots of very, very, very credible sources said you have to sell NVIDIA pre-earnings. Well, here, one of my mentors, if you will, I didn't know him personally, but I've studied William O'Neill for 30 years. He said successful trading is about finding the rules that work and then sticking to those rules. That sounds really easy. This is incredibly hard, because if you have some rules, but everybody's telling you you're wrong, everybody's telling you you should sell when your rules don't say you should sell, that's really, really, really hard to stick to those. So I have rules, and I have a trading system that I have created that includes 4 different sets of rules, completely different. When to buy. Those are my market timing systems. We look at those, and we're going to look at in just a moment, based on the matrix that I've created. What to buy. I've already told you I use fundamental analysis, significant amounts of fundamental analysis, and then technical analysis. Technical is really rules. Actually, both are. When to sell. There is risk management and stop management. We're going to talk about stop management in just a moment. And then there's earnings. Well, when earnings are coming up every 90 days, do you hold the stock? Do you sell the stock? Do you put a stop under the stock? Different ways to manage the risk, but all very, very difficult decisions. So again, bear with me. This is all going to come together in a moment. We're going to look at earnings first. So this is just an excerpt from the rules that I've created around earnings announcements. One of the things I do is I analyze Zacks research rating, and especially, well, I do 2 things. I look at their rating, which I don't use as buy and sell tools. I use it around earnings, and I use their ESP, which is Earning Surprise Predictor. Zacks, if you don't know this, Len Zacks is the founder, still alive, brilliant man, brilliant mathematician. He believes that everything that has to do with a price going up or down is based on its earnings, pretty much everything. So I look at their research every time earnings is coming up, and I'll show you that in a minute. And then, I'm a huge believer in IBD, which is Investors Business Daily. I use their earnings per share ratings. I use their quality of earnings and business model ratings. This is sales, margins, and return on equity. And I look for revisions. Revisions are based on the analysts, the Wall Street analysts, who are the ones who have an expected earnings every quarter for every company out there. And then the company needs to beat those earnings estimates, or meet them, or fail to meet them. So I'm looking at all of this, and I'll show you a spreadsheet in a second. So guidelines to hold a stock through an earnings announcement without a stop in place. It must have at least a 5% unrealized gain, meaning we obviously own the stock, or we wouldn't be talking about holding it through earnings. We have to have at least a 5% gain, unrealized gain, to even ride a company through an earnings announcement. Uh, it must not show a Zacks rating of 4 or 5. They have a rating of 1, which is their buy, and 5 is their sell. And again, I don't use their ratings when I'm making a decision to add a stock, but I use it because it's part of their whole earnings announcement. So if it has a 4 or a 5, I'm going to put a stop underneath it, or I'm going to just sell the stock. I use the IBD, Investors Business Daily, earnings per share. This is new. I just put this in. It must be at least 90, meaning they are beating in their earnings 90% of companies in America. It needs to have an IBD SMR. And all you need to know about SMR is that's the quality of the fundamentals of the stock. It has to be at least an A minus. And then in aggregate of all the stocks on the S&P, a very significant 70% of the stocks during an earnings cycle need to be outperforming and beating their estimates. And when the earnings season starts, if we only have 5 or 10 companies that report earnings, we don't have this yet. But pretty quickly, the stock tables and IBD and Wall Street Journal and all of the other research companies, they start to look at what percentage of the companies reporting earnings for that quarter are beating their earnings. And for me, it needs to be greater than 70%. Should any of the above rules be broken, any of these rules be broken, either liquidate the security or use a stop. Okay, so here are my rules. And let me just go over to something here. Let me just show you here. This is a little hard to see, but don't worry. This is just this, and this is something I just started February 1st. So this is a new spreadsheet. It doesn't have an enormous amount of data. But each one of these symbols are symbols that you may have held because I bought it and put it in your portfolio, depending on your risk. And I do different amounts of analysis, and I'm looking at the Zacks rating, the Zacks ESP, the IBD estimate, the IBD earnings per share rating, and their SMR. I've already mentioned all of those things. And then the day before, I'm looking at what happened to their price and was there a significant change in volume. I'm just trying to find things that maybe will help us in the future with earnings. And I put all of these together, and then once there's some color filled in, it's done. That earnings is done. The ones coming up is we own Massey, which is going to report February 27th. AMC is after the market closes. And then CRM is reporting the 28th after the market closes. If you see BMO, that's before the market opens. So here's what's happening. If we look at NVIDIA, and I do it on different dates. If I look at NVIDIA, it had a Zacks rating of 2 consistently on each of the 3 times I looked at it. These are the dates that I looked at this rating. That's an extremely high rating. It had an ESP that was positive. It doesn't matter if it's more positive or less positive. It just matters that it is positive. And if it is negative, that really doesn't statistically change things. So we don't, I note them, but it doesn't really matter. So disregard that. So for NVIDIA, everything was looking good. If it is ranked a 1, 2, or 3, and it has greater than a 0 ESP, that means, as far as Zacks goes, that the estimates are being raised as we get closer and closer to the earnings announcement. That's really good. Then when it comes to IBD, not on all stocks, but on a lot, they have just an up, down, or NA. They're saying here that the revisions have been going up. Really good. That's really strong. Their EPS rating all 3 times was 99. That means they're in the top 1% of companies in America as far as their earnings. And then the quality has to be an A or a B, and that's here. And then I looked at what happened the day before, and then I put in right when the market opens, this was up 12%, and when the market closed that same day, it was up 16.38%. So why didn't I sell NVIDIA or put a stop in a couple days before? Here's the why. Here is the why. I don't guess at this. I look at the analysis. I know Kathy Wood and everybody else was telling me that I'm wrong, that I should sell the stock. But I believe you have to have rules and you have to follow them. And in this case, it worked out. So I'm just going to go back to I have guidelines and I will adjust these guidelines as necessary, and there'll be minor adjustments. But I'll do that trying to make the best decisions we can, because I'm going to go right back to this. Bill O'Neill said successful trading is about finding the rules that work and then sticking to those rules. Man, that's hard to do, but that's what we did. And that's the answer to why didn't I sell NVIDIA when it seemed like everybody on Wall Street was selling NVIDIA? That's why. Okay. But it doesn't always work. And that's because we, meaning myself and other people who manage investments for clients, we make, or this should have been I make decisions based on probabilities, but they're not certainties. And sometimes our probabilities don't work. But the majority of our time, the probabilities work. And there is nothing in the investment world that works every single time. Nothing. So I know I ran through a lot of this, but if I go back these slides, why didn't I put a stop under here? Well, now I've explained it to you and it worked out. Why didn't I put a stop under SMCI when it looks like everybody in the world was selling it? I didn't because of my rules. It didn't meet my stop rules or my earnings announcement rules. And so far, it has paid off. So I hope that makes some sense to you. And again, I have all of these criteria and these rules that I've created to help us navigate the markets. And again, the single most important thing to know is whether the market's going up or down. Everything follows from there. So let's move over to our matrix for a second. I'm going to go back and I'll show you this. I'm going to just keep updating this, and this list is going to get very long over this next year or so. But this analysis is helping me. For instance, TYL, which we happen to have sold, but their earnings per share was below my 90 threshold. But these are green because it opened up 2%, it closed down 0.67%. That's no big deal. This one, Builder, had a EPS of only 74, and it had an SMR of C. On this one, I actually did put a stop because these broke two of my rules, but it worked out. Everything worked out fine for that. Okay, so here's one that didn't. Yesterday, MELI reported we had a 2, a 0, that's fine, an up. This was down, but this was an A. The SMR was an A. And I didn't put a stop underneath it. And this one we took a hit on. It was down 10%. We still own it because today is Friday. And on Monday, I'll see how it happens, and I may liquidate this stock. But this is an extraordinary company. So again, I'm doing these things because over 6 months, I'll be able to find trends that will help us. If we're 80% successful in our earnings calls now, hopefully we'll be 85 or 87 or 88% successful as we move through this. Okay, so the trend is your friend. Here is updated through today. Group 1, shortest term, most aggressive. We've got all green. Group 2 is a little more conservative, green. And everything else across the board is green. This is the most important thing on the whole sheet. This is our bear market avoidance indicator. We will never ride through a bear market again because of this. The VIX is the fear index. It's actually gone down, which is just extraordinary because the whole week was so crazy. I'm surprised it went down, but it did. I just report it as I see it. And the IBD exposure remained at 4. And 4, if you remember, means you should be 60 to 80% invested in the markets. Okay, let's go over to our chart for a few minutes. And I don't want this to run too long, but this is the S&P 500, and this is each candle is 1 day. what you can see is we've got this beautiful trend happening here. And if I take the linear regression off, you can see that the 8-day moving average is above the 21-day. That's the blue, which is above the 50-day, which is above the 200-day. That's beautiful. That's perfect. That's what we want to see. Okay, you can see here in this short little downturn, look what happened. The 8-day was below the 21-day, which was below the 50-day. Okay, that is a correction. That's not a bear market. That is a correction. And then it turned back up. These things happen. They happen all the time. But while the 8 is above the 21, especially if you just focus on those two lines, and the 8-day is pointing up, this is healthy. This is a pure healthy market. Why shouldn't we be in this market? If I put the linear regression over it, which I've explained many times, sometimes it'll dip below and then it'll come back in. We are just above the mean for this linear regression. So the market looks really good and really healthy. I also look at, I don't focus it on the videos because I don't like to make the videos too long, but here's the Qs, the NASDAQ 100. Same thing. And even here, you could see that the 8-day dropped all the way down to the 21-day, but it wasn't called a pullback yet because it didn't go below the 21-day. That's my rule. And so it just kept going up, which is what we expected unless it crosses. Okay, so I just want you to know I'm looking at both. I also spend a great deal of time looking at the weekly. Here's the S&P 500 on the weekly, because the weekly smooths things out. And actually, let me change this. We use different moving averages. The white is 2 weeks, and then 10 weeks, and then 20 weeks. The 10 and the 20 is our bear market avoidance indicator. We are right at the top of the channel, which means we could see a little bit of weakness. I wouldn't be surprised, but we may not. We may not. So if I go back to the other moving averages and I go back to daily, here we are. So I hope this helped. I don't know if this was a confusing video or a helpful video. Maybe you could let me know when you get a chance. But I have just found that being rules-based helps. And I'm going to go back to the slides and I'm going to end with this. Let me ignore this. Whoops, excuse me right now. Let me just clean this up a little bit. I'm going to, it's not letting me. There we go. I'm going to go back to SMCI because this was a really big one. I had sold 25% of our position because one of my rules is if the position grows too high, I trim the position. And also it was just exceedingly over this linear regression. That's why I sold 25%. That's called risk management. That's not called stop management. That's risk management. They're two different things. I had a client ask an incredibly good question. Why sell 25% of one of our best stocks? Why not just put a stop, some kind of a trailing stop? And the answer to that is because of what looks like manipulation, we would have lost our entire position in SMCI, and we would have missed this. Now, granted, we're not higher than here yet, but the point is we have different rules for different things. And the bottom line, like I said, is rules work most of the time. They don't work 100% of the time. They're not certainties. They are probabilities. So the bottom line is I'm going to wrap up with this. We're in, and I showed you this last week, we're in kind of a weak area of seasonality, which is now through the end of March, which is the second half of the first quarter. So things could be rocky for the next couple of weeks. I wouldn't be surprised. If SMCI continues up, I'm going to tell you right now, I'm going to take another 25% off of our position. That is very good risk management. And then we'll have 50% of our position that's way over 100% growth. And what that means is, think about this, that means the 50% we have left in there, because we took 50% of our earnings off the table and put them in the money market account, that means we have a position in SMCI with zero risk of our initial principal. Zero. That's a good thing. So I may trim it and let's see if it'll continue to grow. And if it does, great. If it doesn't and takes another big hit, we'll only be taking a hit on 50% of our position, not 100% of our position. I really hope this makes sense. I know that a lot of this in this video was out of the norm for what I try to present and maybe a little confusing. If you want any more explanation on this, all you have to do is shoot me an email or hop on my Zoom calendar and we can do a one-on-one and talk about it further. But again, I'm almost 40 years in this industry, and what I have learned, a lot of what I've learned is from Bill O'Neill, but what I've learned about rules is from Bill O'Neill, and it has served well. So I'm going to continue to refine them and follow them. And like one last thing is, I don't follow all of his rules because he sells positions when he's up 20 to 25% more times than not. Well, we're up about almost 200%. So he would have missed this. So again, I'm not blind when I follow rules, but I create my own based on my knowledge that I have gained over the decades. So again, rambling here. Sorry about that. If you have any questions, let me know. Other than that, have a great weekend. We will be back at this Monday morning. Again, the next 5 weeks could be a little bit rocky. I don't know if they will be, but they could be. So just know that that's normal. That's part of seasonality, and we will go from there. Okay, have a great weekend. Let me know what you think of this video. I'd appreciate it. Bye-bye.